Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So already 4 main problems we have completed on ratio analysis. In this video, 5th and 6th, these 2 problems I'm going to explain you in detail. So before starting the video, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep ready the problem. Now see the 5th problem. Following financial information relates to Mayank Limited. Balance sheet of Mayank Limited as at 31st December. Shareholders fund share capital 20 lakh, reserves and surplus 7 lakh 36,000. Then trade, current liability, trade payable and other current liability. So assets, fixed assets 14 lakh 40,000. Current assets, current investments, inventories, receivables, prepaid insurance. So total of the balance sheet 33 lakh 84,000. Additional information, revenue from operations are given 80 lakh, less cost of revenue from operations 61 lakh 60,000. Then less operating expenses 13 lakh 60,000. Then next page, profit before tax is 4 lakh 80,000, less tax 50% 2 lakh 40,000, net profit after taxes 2 lakh 40,000. So we are given the income statement and also we are given the balance sheet. Equity shares have face value of 100 rupees each. That means the face value of each equity share is 100 rupees. Calculate the following: current ratio A, B quick ratio, C stock turnover ratio, D operating ratio, E debtors turnover ratio, F market value of the share if price earning ratio is 10 times. So these are the ratios specifically given in the problem we have to calculate. But before starting that, take a screenshot of the solutions of 5th and 6th problem, then I'll explain. Now, first of all, a bit. It is asking you to calculate current ratio. Already we know the current ratio formula is current asset by current liabilities. So in the balance sheet, you can see current assets are current investment 2 lakh 40,000. Then inventory is 9 lakh 60,000. Receivables 7 lakh 20,000. And prepaid insurance 24,000. These 4 are the current assets. The total of the current asset 19 lakh 44,000. And current liabilities are 2. Trade payable 6 lakh 8,000. And other current liability 40,000. 6 lakh 48,000. So we have current assets, we have current liability. So current assets divided by current liability 3:1. So one ratio we have completed, that is current ratio. Second, B bit. It is asking you to calculate quick ratio. The quick ratio formula is quick asset by current liability. So how to find out the quick asset? The total current asset minus inventories minus prepaid insurance, prepaid expenses. So in our problem, the total current assets are 19 lakh 44,000. From this inventories, the inventories are 9 lakh 60,000. And the prepaid expenses are 24,000. It is given in the problem. So deduct these two, quick assets are 9 lakh 60,000. Now we can find out quick ratio. Quick ratio, quick assets 9 lakh 60,000 by current liability 6 lakh 48,000. So 1.48:1. This is the quick ratio. 2 ratios we have completed, current ratio and quick ratio. The third ratio is stock turnover ratio. The formula for stock turnover ratio, cost of revenue from operations divided by average stock. In our problem, opening stock is not given. So we cannot calculate average stock. So we take the closing stock. Closing stock means inventory, which is given in the balance sheet. In the balance sheet, inventory is given 9 lakh 60,000. That will take. The cost of revenue from operations given in the problem 61 lakh 60,000. 61 lakh 60,000 cost of revenue from operation. And closing inventory is given 9 lakh 60,000. So average stock we cannot calculate. So alternatively we can take the closing inventory. So 6.42 times. This is the stock turnover ratio. Next is operating ratio. The formula is cost of revenue from operations plus operating expenses divided by revenue from operation into 100. Previous videos, previous problems, we have applied this formula. Now, cost of revenue from operations given in the problem 61,60,000. Operating expenses are given 13,60,000, and revenue from operation it is given 80 lakh into 100. So finally, operating ratio is 94%. That's it. Next comes debtors turnover ratio or receivables turnover ratio. Means same. The formula net credit revenue from operations divided by average receivable. Again, we cannot calculate average because opening receivables are not given. So we take closing trade receivable. In the balance sheet, you can see receivables are 7,20,000. That will take in denominator. And numerator, we don't know how much is the credit revenue from operation. So whatever revenue from operation is given, that only will take. That is 80 lakh. So 80 lakh revenue from operation and trade receivables are 7,20,000. 11.11 times. This is the receivables or debtors turnover ratio. The next is market price per share is how much if the price earning ratio is 10 times. See here, this first time we are applying this ratio. We need to find out what is the market price per share when PE ratio, price earning ratio is 10 times. First of all, we need how many shares are there, how many equity shares are there. The total equity share capital is 20 lakhs that is given in the balance sheet. And the face value of each share is 100 rupees. Last paragraph it is given. The face value of each equity share is 100 rupees. So how many shares are there? Total equity share capital 20 lakh. And the face value of each share is 100 rupees. So company is having 20,000 equity shares. The company is having 20,000 equity shares. Now we calculate EPS, earnings per share. The formula is PAT minus preference dividend divided by number of equity shares. Number of equity shares. PAT, it is given in the problem. Profit after tax is given in the problem. Last sentence, that is 2,40,000. Preference dividend is not there. The company does not have preference share capital, so there is no preference dividend, 0. Divided by number of equity shares 20,000. So 2,40,000 divided by 20,000, you get 12 rupees. What is this 12 rupees? EPS, earnings per share. Finally, we need market price per share. We apply the formula for PE ratio. Price earning ratio. The formula is market price per share divided by earnings per share. So PE ratio, formula is MPS by EPS. Market price per share divided by earnings per share. The PE ratio is given in the problem 10 times. So in place of PE, I am writing 10. MPS we don't have. We have to find out. And EPS already just now we have calculated 12 rupees. 12 rupees is the EPS. So substitute 12 rupees in place of EPS. Now cross multiply. MPS into 1 is MPS. 10 into 12 is 120. So we got market price per share 120 rupees. That's it. This is the end of problem number 5. Now problem number 6. See carefully. Sixth problem. Following is the information pertaining to Satyanarayana Limited as at 31st March 2017. Equity share capital 50,000. Preference share capital 10,000, general reserve 32,000, profit and loss account 20,000, debentures are 20,000, sundry creditors 30,000, fixed assets, non-current investments, inventories, receivables and bank balance. This is the information given of Satyanarayana Limited. The directors intend to transfer 5,000 out of current year's profit of 20,000 to provision for tax. So what the directors are deciding that out of current year's profit of 20,000, they want to transfer 5,000 rupees as provision for taxation. Remember, provision for taxation is a current liability. So what we have to do? Deduct 5,000 from 20,000. The remaining 15,000 is the current year's profit. and that 5,000 rupees will be taken under current liability. It's a provision for tax. You are required to calculate return on capital employed, current ratio, and return on equity shareholders fund. So 3 ratios it is asking you to calculate. First of all, return on capital employed, ROCE. The formula is PBIT divided by capital employed into 100. Already so many problems we have applied this formula. So first we need PBIT. PBIT is equal to PAT plus interest plus tax. So PAT, profit after tax. Actually 20,000 rupees is current year profit, out of which 5,000 rupees is asking to transfer it to provision for tax. So deduct 5,000. The profit after tax will be 15,000. And interest. Interest is paid on debentures. So in the problem it is given 6% debentures rupees 20,000. So 6% of 20,000 comes to 1,200. And tax, provision for taxation is 5,000. So PBIT, profit after tax is 15,000, interest is 1,200, taxation is 5,000. So PBIT is 21,200. Now we need capital employed. For capital employed, we take equity share capital plus preferential capital plus undistributed profit plus reserves plus long-term debt, which consists of debentures, minus fictitious assets minus non-current assets. This is a complete definition of capital employed. But in our problem, we don't have fictitious asset. We don't have non-current assets. The only thing we have is equity share capital, preferential capital, general reserve, P&L account and debentures. These are the items in our problem given. So equity share capital is 50,000, preferential capital 10,000, general reserve 32,000, profit and loss account balance 15,000 and debentures are 20,000. Profit and loss account means PAT, profit after tax, 15,000. Now total capital employed is 1,27,000. Now we can substitute ROC is equal to PBIT 21,200 and capital employed 1,27,000 into 100 because it's a profitability ratio. So we need percentage, multiply by 100. So 16.69%, this is the ROCE, return on capital employed. Secondly, it is asking you to calculate current ratio, current assets minus current liability. So current assets are given in the problem: inventory, receivables, bank balance. So 3 items. Inventories are 30,000, 13,500, 7,000. So total current assets 50,500. Current liabilities are given: sundry creditors 30,000. But apart from that, provision for taxation 5,000. So 30,000 plus 5,000, 35,000. That is the current liability. 30,000 plus 5,000 is equal to 35,000. Now current ratio is current asset by current liability. So 50,500 divided by 35,000, 1.44 is to 1. So 2 ratios we have completed. The last ratio is return on equity shareholders fund. So how to find out? The formula is PAT minus preference dividend divided by equity shareholders fund. So first of all, equity shareholders fund means equity share capital plus reserves plus P&L account. 3 items we are taking. Equity share capital is 50,000. General reserve is 32,000 and profit and loss account balance is 15,000. Out of 20,000, 5,000 transferred to provision for taxation. So total equity shareholders fund 97,000. And what is the preference dividend? It is given there 8% preference share capital 10,000. So 8% of 10,000 you will get 800. This is the preference dividend. Now we substitute in the formula. Return on equity shareholders fund is equal to PAT minus preference dividend. PAT is 15,000. Preference dividend is 800. Divided by equity shareholders fund 97,000 into 100. You will get 14.64%. This is the return on equity shareholders fund. Totally 6 main problems, 14 short problems and 6 main problems I have completed on ratio analysis. So if you want to have a perfect knowledge, watch all the videos from beginning till end. Don't skip in between and don't join in between. And before watching these problems, first of all, you should be thorough on the formulas. First 4 videos I have explained in detail regarding what are the different formulas in ratio analysis, what is the significance of each ratio, what does mean, like current ratio, what is the purpose of current ratio, what is the purpose of gross profit ratio, all these things I have explained. So watch the first 4 videos, be perfect on the theory, then you come to the video, come to problems. So inshallah we'll continue the same problems in the next video. The 7th problem will start in the next video.